This has never happened before. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a new report that shows consumer demand outright crashed in the fourth quarter. We're going to take a look at that report and see how it is likely to impact the manufacturing sector. Plus, we've got some new evidence that shows the Fed may be closer to a pause than they think, and some political posturing that's likely to lead to politicians kicking the can down the road. Let's however, we pick today's story up with the headline, Smartphone shipments suffer the largest ever decline with 18.3% drop in the holiday quarter and 11.3% decline in 2022, according to IDC. We've never seen shipments in the holiday quarter come in lower than the previous quarter. Now, if you think about what smartphone companies tend to do and why that last quarter of the year is so important, because they tend to announce a lot of new models, put them out for ship, they put them on the stores, people go buy them, and you see demand in the holiday season for the latest and greatest smartphones tend to surge. And so when we see this crash in demand, it's a bigger picture of what's going on in the real economy because of smartphone demand falls. Well, what do you think everything else is doing? However, over the weakened demand and high inventory caused vendors to cut back drastically on shipments. We're going to talk more about that in a moment. Heavy sales and promotions during the quarter helped deplete existing inventory rather than drive shipment growth. Vendors are increasingly cautious in their shipments and planning while realigning their focus on profitability. What this holiday quarter tells us is that rising inflation and growing macro concerns continue to stunt consumer spending even more than expected and push out any possible recovery till the end of 2023. Now, why are they saying this? Why are they saying that recovery isn't going to be till later this year? Because there's some key words in there that we can go back and look at, and that word is inventory, high inventory. So we start thinking about that and how that impacts the manufacturing sector. What we should expect to see then is the manufacturing sector slow down, likely lead to some layoffs. We need to see the inventory levels come down and then demand start to build back up. What this report is saying is that's not likely to happen until the end of the year and maybe at best. Now let's dig into this manufacturing picture. So here we have current inventories heading over to the Philly Fed, and they don't have a lot of data on this series, whereas normally we do have a lot. But what we see, current inventories in the factory level, well, they've been contracting. We see below the black line, which says they're trying to pare them down back going into early 2020 and on. So what we're noting here is the inventory problem isn't at the factory level, it's at the retailer level. Let's take a look at this next chart. So here you can see retailer inventories in blue against advanced retail sales in red. Now these are shown as millions of dollars, and you can note that of course retail inventory skyrocketed and of course demand has gone up, but inventory has been going up faster. And so what we can know going back at least to the great financial crisis, that retail sales will head lower, and that will lead eventually the inventories to head down. So what we really need, if you think it from an economic standpoint, we need demand to stay higher so that way we can eat through this inventory and just scale back the manufacturing sector. If we see demand outright plummet, then what you're going to see then is retailers forced to unload their inventory and they're going to cut their new sales orders, and that's going to have a massive impact on the manufacturing sector and of course employment. Let's dig a little deeper. Here we can see future inventories as we look at the manufacturing sector now again and try to predict what they think is coming, and they're saying with a 6-month lead. So where does this put this? About the middle of the year, they believe that their inventories are likely to grow. So what they're saying in between now and then, there's not a lot happening that they're looking at, but there's some more details we can look at here, because I think the bigger picture is what happens to new order demand, and we can see that here in red, still staying with the Philly Fed against retailer inventories. And we can note that periods where you see this red, and I know it's very noisy, but as the red line trends down below the yellow line and stays down there for a while, what do we see with retail inventories here in the dot-com bubble? Well, they flattened out and then declined a bit. What do we see during the great financial crisis? We see new order demand fell and inventories then eventually went down with it. What do we see now? Early stages showing that new order demand is falling, but we have such a huge overhang of inventory that it's got to come down significantly before we can see the engine of the factory's machines come back to life. Otherwise, they're going to have to idle these things down just to a minimum level because they desperately need this inventory not just to go, but go quickly before a lot of these products become obsolete. We continue to witness consumer demand dwindle as refresh rates climb past 40 months in most major markets. However, on a positive note, they say consumers may find even more generous trade and offers going into the 2023 market, and that could drive sales. And of course, we think about this. What we need to do is we need to see consumer demand increase. What they're suggesting is it's not increasing, and that is the ominous sign. And we talked about this in yesterday's show where the JP Morgan analyst Marco said, hey, I think we're going to be in a recession by the middle of the year. And that is echoing now into the supply chain saying, hey, look, we've got too much inventory here. We're idling back the factories to try to adjust for this. And we don't think there's a recovery till the end of the year, at least not if demand comes back. Imagine if demand doesn't come back. Here we can see advanced retail sales now overlaying against current new orders, and what do we expect to see? Just what we saw with retailer inventories. As, of course, new orders go down, retail sales eventually follow, and all that means here is what you're seeing is, of course, a demand issue. Of course, retailers don't want to cut back their new orders, but they start to cut it back, the economy starts to pull back, and next thing you know, demand is actually worse than we thought. And so right now we're just looking at one quarter. The question we want to know and the answer we're hoping to get is, does demand come back to some level in the first quarter? It's still too early to say. We don't have any data. If it doesn't, now we have that base case where we're headed into a recession by the summer, and hopefully if it's mild enough, and we don't know yet, that we'll pull out of it by the end of the year. If it's not, well, by the end of the year, things could look a whole lot worse. But one place they're not looking worse is the machine position in the market, which is baffling because many people can't figure out why the market goes up. Well, if you were on their daily report for CTA-Timer Pro, still $20 a month, price going to $30. And if you subscribe and miss that, you got to get it while it's 20. But based on the historical modeling here, the slow algorithms are now buying S&P and NASDAQ futures, suggesting that what the report is trying to tell you is, based on a historical model, the machines want to buy this market because momentum's higher. It means it's got room to run. And in the weeks to come on our Sunday show when we talk about it, what I suspect we'll see is a lot of the machines starting to play catch up. But now let's talk about the Fed, because there's mounting evidence they may be closer to a pause than they want to admit. Key inflation gauge cools further, paving the way for smaller Fed rate hikes. Personal consumption expenditures core, which excludes food and energy, rose 4.4% in December from a year earlier. The overall gauge climbed 5% year over year, still well above the Fed's 2% goal. But here's a notable part, but both were the slowest paces since 2021. And we know that that is the key part here. It's not where it's at, but what the trend is. And of course, the bond market has been telling us and screaming that this is actually going to happen, and inflation is coming way down. Here we can look at the personal consumption expenditures, the core PCE, which excludes food and energy, against the 10-year 3-month yield curve. Notably, where the yellow line is denotes an inversion of the curve. And here we can see a curve inversion and the core PCE is coming down. Here we could see a near-term inversion, another inversion right here. And what happens? PCE comes down, inversion, core PCE down, inversion, core PCE down, massive inversion, telling us everything we need to know. And that is that inflation is coming down. The probabilities the Fed is closer to ending their rate hike cycle and beginning to cut is actually now in the cards. We'll find out more on February 1st, but the probabilities they're going to at least go 0.25% are pretty good. But now after that, well, that means pause and maybe even a cut. From a month earlier, the core gauge with Fed Chair Jerome Powell has stressed is a more accurate measure of where inflation is heading, was up 0.3%. Meanwhile, the overall PC price index, which does include food and energy, increased 0.1%. But get this, both were driven almost entirely by services. As key words here, goods disinflation continues. And now you go back to the story, our headline story of smartphone shipments crashing, demand for goods falling. At some point, the services sector gets hit, and you'll see both of them now. But disinflation in the goods sector, and as I said, that leads the services sector. Personal spending adjusted for changes in prices dropped to 0.3% in December. Inflation-adjusted outlays for merchandise fell 0.9%, while spending on services stagnated. Bingo, there you go. The first month without an increase since January 2022. So spending down. How about this? Incomes, unadjusted for inflation, as well as real disposable income, climbed 0.2% last month, as wages and salaries, unadjusted for prices, advanced 0.3% from November, suggesting that consumers are starting to retrench here at a time when politicians, well, they're doing what they do best, which is kick the can down the road. Debt ceiling saga puts the Treasury's financing estimates under scrutiny. As I said, don't worry, this won't matter much. The Treasury on Monday will release estimates for federal borrowing and cash balances through March and the key April-June period, as it includes the tax collection deadline and the estimated end of measures used to remain under the debt ceiling. If we look forward now, House Republican leaders are considering proposing a short-term extension of the federal debt ceiling to delay the risk of default until September 30th. The plan would kick the can down the road and further muddle the Treasury's financing outlook, making the path to a resolution more treacherous. But didn't we kind of predict that the other day in our show on China, where they said they had leeway to go to the third quarter? Well, no surprise. You likely expect them to do that, but it's all political posturing. Don't worry. They will eventually pass a budget. But in the meantime, the key factor here is consumer demand is falling, inflation is coming down, and the Fed is almost tapped out, meaning we're much closer to the recession that many people are talking about than we're further away. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.